This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. Serena, welcome to the show. You have some skills that I bet our listeners are not as familiar with, or different options, for investing, that, or at least one specifically that we're going to dive into that I bet they don't know is out there, and you've become an expert in this and been very successful. So I want to jump in, but man, who is Serena, and welcome to the show.
Great. Thanks for having me.
Yeah, tell us a little bit about yourself, and let's jump in there, a little bit of background, and then let's dive into how you got into private lending, and kind of your path to there, but then, man, what that could do for other investors, right? It's just exposing them to this platform.
Yeah, for sure. So I had my own brand experience agency for 18 years, and I actually sold that just at the beginning of last year. I had tried to sell it just before COVID. No one knew COVID was coming, so it was very horrible timing. I listed it for sale, and we went into lockdown about 2 weeks later. So I kept the business going over the span of a couple of years and finally sold it last year just so that I could focus on my family and go into real estate full time. And as you mentioned, I've done a lot of private lending. So I also had many other sources of income to depend on that I kind of, found my path to that through a client actually that I was staffing events for in Texas and Florida. And they have kind of like a real estate education company. So they teach a lot of beginner investors all the different concepts associated with real estate investing. And I happened to talk to a girlfriend of mine about it, and she has her own hair salon. And she's like, you know what? I got to introduce you to my mortgage broker. I do private lending with him, and I actually make more money doing that than I do from my business. And at this point in time, I was obviously getting into all of this stuff, but I was also looking to start a family. So I wanted to decrease my dependency on income from my business so that when I took a step back, I was worried would sales go down? I just wanted to leave as much money as I could in the company. So I started working with her mortgage broker, and also another one that I did some syndicated mortgages with. And in the first year, I was able to cut my pay in half, and then introduce COVID. So I didn't want to take any money out of my business at all. So I was able to dial up the private lending that I was doing. And then at the beginning of last year, very significantly scaled it. I had been doing probably between 3 to 6 deals a year. And I think last year I did 26. So I've just now confirmed, I think I signed my 59th deal in the last couple of weeks. So I just keep the money moving, as things are coming to an end.
Wow. 26 deals last year. That's a lot. Right. And I assume, I guess, let's walk through, why don't we, a little more elementary approach for just a moment, what is private lending, and what is this, how could our investors who are listening even consider thinking about doing something like that?
Yeah. So from a mortgage broker's perspective, in some instances, there could be people that need to pay off a line of credit before their mortgage closes or something like that. So for the broker that I was working with, sometimes it could be short-term business loan for someone that needed these other short-term loans. So say, for example, they've got 20 grand on their line of credit. They need a 2-week bridge loan before their mortgage closes. So they might be willing to spend $2,000 to wipe that clean so that their mortgage can close. So you're kind of fulfilling that need for them. Or like I said, it could be a business owner that maybe they need money for whatever period of time. So some of those loans have been principal and interest. So one of my first deals was for $45,000. It was 20% interest. So I got a ratio of the payment towards the principal and then the interest monthly over the span of 2 years. In most instances, they even paid it off early because they don't want to be paying that high interest longer than they have to. And then in some cases, they could also be interest only loans. So that would be common with land developers, people that are renovating single family or multifamily properties. And then when the property refinances, they pay back their investors and then take out the additional money in terms of equity as profit for themselves. So it varies in terms of the needs that people may have. And like I said, I just try to work with as many people as possible to kind of insulate my risk in that sense.
Yeah. Yeah. And I wanted to get to the different types of maybe asset classes, things that you're lending towards. Or let's just do that now. What does it normally look like? And then, how do these people find you? But, go into what they're doing as well.
Yeah. So, everyone's risk tolerance is different. The majority of what I've done is unsecured private lending. So that would make a lot of people very nervous. That being said, there's almost always real estate involved. So there is a level of tangibility, and most of the agreements that I have still have a property reflected in the agreement. So while you may not be registered on title like a first position mortgage, there's still a property usually reflected in that agreement. So I feel like if push came to shove, that's usually what you'll do. But then I'll take added measures to verify their identity, that they're on title of the property that's listed, credit checks, make sure if they're renovating, they have builder's insurance, and there's other things that I'll do, and often have a lot of trusted referrals. So I'm like in the most risky boat because I'm chasing the interest. Initially I was loaning out when I had 3% on my HELOC. Now it's 7%. So I want to have those 20% returns because you need to make that spread. Other options for people could be like a first position mortgage, or they could do something like an equity partner, whether it's joint venturing on a project where they're an actual shareholder in the property. And sometimes you'll see situations where it's like a GP LP structure. So the working partner is a general partner and you'll come in as a limited partner. So you're shielded from risk. And I have a couple of those as well. And, they're fairly common. They're more complex and expensive to set up, but there are some of those floating out there as well.
Yeah, I guess, some investors, I'm sure they're listening, like, why would I become a private lender versus just investing in a syndication, or being more passive?
Yeah. So I guess it depends on, like I said, your risk tolerance plays into it. So a lot of first position mortgages, what I've seen, they'll be like 10 to 13% in terms of interest. The unsecured private lending at more like 14 to 20%. So again, if you're just coming in with cash, maybe you want to make sure like you've got 100% security and stuff like that. Like I said, I just try to work with a lot of different people, and like touch wood. The only thing that's really gone a little bit wrong is the syndicated mortgages that I invested with. And at the time I did 3, and they were laddered with a 12-month, 18-month, and 24-month term. And the issue is that it's been very significantly delayed. So in this instance, the mortgage brokerage kind of misrepresented themselves in some ways. Like I thought that they were brokering deals for other borrowers. And it turns out that they actually had some of their own deals in the pot. Some were land development. And basically 1.5 of those deals has now gone on for 5 years. They are still paying the front end interest, but they've even said in the most recent update, they might need 2 more years. So what should have been like an 18-month term could go to 7 years. So for me, all the other private lending I've done paid off what I put into that. But you could imagine if someone had just done that, no one knew COVID was coming. So what if they needed that money back, right? So a delay like that could have been a lot more challenging for some people compared to what I experienced. But my learning from that was not to put as much money into a deal, because I did about 335,000 between 3 deals then. Now I don't do more than 50,000 a deal. And it also had split interest. So it was 15%, half of it's paid up front, half at the back end whenever that back end occurs. And now, they've said there's a possibility that back end interest could be compromised because it's gone on for so long. So I generally don't touch anything that has that kind of a split interest circumstance anymore.
Speak to maybe some of the risks that the investor wouldn't even know to ask or think through, right? Just to understand if it fits their risk tolerance.
Yeah, I mean, in this instance, they had in their paperwork that they could extend for 6 months twice. And as it turns out, as long as they're paying that front end interest, like it could go on and on and on. And as I've also learned in a GP LP situation, the same thing, like they could put a window on it, but because of that specific arrangement, it's not like there should be a defined end, but it could go on longer. And there's nothing the LP could do in that circumstance. I think if you really want out, the GP might be able to replace you, but at the end of the day, there is that chance that things can go on longer than anticipated. So I think that's why I've liked some of the general security agreements. Like it's a very specific fixed date. In some cases, the borrowers have asked, do you want to keep your money in and roll it over to another term, or do you want to be paid out? So if you want to be paid out, they'll usually just replace you. They're not just going to kind of hold you hostage in the deal. So I think that's, one of the elements. I think obviously in the worst case scenario, you can always lose your money. I did talk to an investor that had put $100,000 into a deal with an actual like real estate investing coach that she had. And the bank foreclosed on the property. And even though there should have been enough equity to pay her out, the bank charged like $250,000 in fees because it had to foreclose, and she wasn't able to get her money out. So even though there was a property, there should have been that equity. There was like, that situation. And I think she did try to pursue him legally, but because he has a lot of different corporations set up and stuff like that, she was never able to recover it. So I think, it's wise never to invest more money than you're willing to lose. And just, like I said, do smaller amounts if you can and just work with more. So in most instances, minimums are 50, some are 25, some could even be lower. It just really depends on who you're working with.
Speak to analyzing the opportunities and how they find you.
Yeah. Well, I mean, initially I was proactively trying to find those opportunities. So I was introduced to a lot of people and I would just feel them out in a lot of ways. Like they're obviously recommended, but what are their terms? How are they explaining things? Like, am I comfortable with the way that they're going to communicate with investors? Some of them will provide updates on like private groups for their investors, showing progress of those properties and stuff like that. So you can feel confident knowing like they're actually doing the work. They're not just taking your money and who knows. So I think that played into some of that. And again, I would look them up to make sure that they're on title in some instances. So I get their identification, double check. In some cases, like I even saw an extra person on title. So I'd ask that that person be added to the agreement. So there could be things like that. It's always good practice to run credit checks, get copies of insurance and stuff like that. So it just depends on who they are and what they're doing with the money. But now I think because I have been on different podcasts talking about these opportunities, now it's, more and more people have come to me just presenting those opportunities. And that way, in some instances, I can share those with other people that are looking for opportunities that may not be in these investing communities and stuff like that.
What's your normal, I guess, your comfort level around the terms that you're offering, and length of the investment?
Yeah, I would say a year is generally my preference, just because again, life can happen and change, right? So I don't want to commit to something that could be like 3 years or 5 years, or I even saw one recently that was for 10 years. And I was like, oh, like it's just so much that can happen in 10 years. So I just feel like that was a little too long. And I understand why it was set up that way. Like it was more of a buy and hold strategy with equity partners, but it just, to me, that was just too long. And even if you decide that you do stay in for 10 years, I still would want that option that I could exit in a year or two and maybe roll it over continually rather than be just locked into something like that. So that's my personal preference, but it just depends on what somebody wants. And then now a lot of people, at least here in Canada, are coming up with mutual fund trusts. So those are, set up where it's like groups of properties, and they can also take registered funds. So for us, RSPs, TFSAs, and stuff like that. So you can just find higher yield opportunities that could be in the range of 22, 26, 30%. And you're kind of putting that into your registered funds for more of like a long-term savings.
We are all thinking about the future, right? And hopefully you are thinking about many years from now, not just 6 months from now, and what your finances look like. Man, that word tax always comes up in our conversations at times, or probably not often enough, as far as planning and being really good at planning. But our guest today has some strategies that I think all of us need to be aware of. And she's written a book recently that's going to help us to better understand those things. Welcome back to the show, Stephanie.
Thank you so much for having me.
Stephanie, update the listeners a little bit about who you are, your background. You're a wealth strategist, author, numerous things that you've done that's helped you to get to where you're at now to help us, and others with building wealth and doing it well and tactfully. But tell them a little more about your background.
Yeah, I was an insurance agent for about 16 years. But while in about 2016, I started doing real estate syndications, and I was sort of the partner in the group that raised the money. So I dealt with a lot of wealthy investors and got to know them pretty well. We have about 300 million of assets under management, and I'm now sort of transitioning into this, I guess, second phase of my career where I've written a book to kind of make people aware of what the wealthy are doing with their money, because it's very different than what we're doing with our money. Yeah, so I wrote this book, and now I'm just trying to get out and talk to people about some strategies that they might not be aware of.
Yeah, well, let's dive into a few of those strategies, right? I'm sure there's many myths that come along with wealth building as well. Why don't we talk about some of the myths, and we'll dive into some of the specific strategies as well?
Well, I think a really important myth that I address a lot is that you need to invest in people say, oh, well, the person got wealthy because they invested in very high risk investments, and that's why they got all their money. But actually, nothing could be further from the truth. And I'm sure you're aware of that too, dealing with investors, is the wealthy ones are very, very concerned with the risks and understanding everything that's involved with an investment. They do that with real estate. They do that with everything. They try to actually have an asymmetric return, really is more realistic to what an investor wants. They want a very large return for a very small amount of their money that they put in. And that is a big part of it. I know part of my book, I go into just what losses, just plain old losses, do to your portfolio. And maybe a lot of people don't really think about that, but that is super impactful when you're, let's say the stock market last year went down 25%. Well, they say, well, I'll just need for the stock market to go up 25% this year. That's actually not true. They need a return of 50% just to get them back to normal. And that can take years and years and years.
Yeah. Wow. That's probably not good news.
Yeah. No.
For most. But yeah, often we do believe it has to be something high risk to get the high return. And I think the people who they become wealthy, right? It's because they have taken the time to analyze those risks and the returns, and in their specific portfolio. Maybe is there another myth maybe we could discuss before we dive into a strategy?
Knowing, I guess, what losses do to your portfolio, and actually not only that, but probably a little bit more. I dive pretty in depth about the 401k, and just being aware of what fees do to your returns as well. Because I think it's in my book, but I believe it's that 80 to 90% of people don't even know they're being charged fees on their 401ks. And I go through like a step-by-step of 3 people. And the fees are 1% for one person, 2% for the other person, 3% for the final person, and just show what that looks like over time. And it is hugely and crazy of what those compounding fees do to the returns and what they think they'll be getting out of their 401k. So I just try to make people aware of what those fees are, and if they want to stay in the 401k, what they can do to, get into low risk without fees being assessed to them.
Yeah.
Or very low fees anyways.
Yeah, it's interesting that higher percentage don't even know that they're being charged a fee, and then you don't really think about how that affects you long term, right? So, all right, let's get into some strategies. I know, the tax treatment diversification, that's one, maybe, but is that a strategy that we should dive into right now, or what would be the maybe top strategy that you would want to highlight?
Well, I think it's really important. And again, we both have seen this with real estate, is that real estate is more a tax advantaged product. So people really get some great tax advantages from working with real estate. But then there is the 401k, which by and large, most everyone does. And that's tax deferment, And what I'm bringing to light is that it's really important to have your money in a few different buckets, maybe a little bit in the tax advantaged, which is real estate, tax deferment, which is your 401k, but tax-free bucket is usually something that is not utilized at all. Because really people think the only way that they can take advantage of that is through a Roth IRA or 401k, which they have to, usually it excludes people that make higher incomes, like 100,000 or more. But what I found is that there are some strategies that the wealthy use to kind of get around that and be able to have a lot of tax-free income when they retire.
Maybe give us an example, or let's think through that a little bit.
The product that I'm talking about is it's a premium finance life insurance. Now everybody freaks out when they hear the word life insurance. But actually, this is a most people have never heard of this, even agents that are in the financial space. This has really been utilized by people that make 25 million or more for years. And it functions very much like a real estate product in that you go in and the bank will pay, probably 75 to 80% of the premium on this policy. And then you leverage into this large investment with only 20 to 25% of a down payment. And then this policy grows. The way that it grows is that it is linked to the stock market and that it only takes the ups, but it doesn't take, if there's a loss like last year, if it's a 25% loss, they get a zero. You just a plain zero. And I could go into more detail about how the insurance company is able to do that. But basically think of it as a way, say you leverage into $1 million real estate product, you put $200,000 down. Now say that real estate goes up 8% in the year. You don't make 8% on your 200,000, you make 8% on the $1 million, which is exactly how this product works, except it is not real estate. So you don't have to worry about any kind of losses that would be associated or risks associated with the real estate, if that makes sense.
Yeah. And how would somebody learn about something like that or even start, using a platform like that?
Unfortunately, there isn't a lot of information about this product because it has been reserved for the extremely wealthy. You can contact me, or you can, look around on the internet. There's not, like I said, a great deal of information. It's called premium financed insurance. And what they have opened this product up in the last few years to accredited investors. So if you can prove that, you have a net worth of $1 million, this is definitely a cool strategy to look into.
What's the risk for that?
The risks are if, say, the market doesn't go up, like if we had 10 years of 0% returns, which has never happened, that could be something. Also, interest rates do affect this product. It's just like a loan, like anything else for real estate. So we try to get them in the best loan possible, lock them in for a few years. But this is a different product in the sense that we're looking at it on an annual basis to be sure that, yes, they are in the right loan, the lowest loan they can get. And let's see, what did the market do this year? Our track record for the past 10 years is 9.53% returns on this product every year. But the key is that when you leverage the money in, you leverage about $1 million in from the bank, it grows like gangbusters. And then the person is able to get the loan out, or they're able to get money out when they retire tax-free, which is very significant because the money grows tax-free while in the product, and then it's distributed tax-free.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.